Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Andrew Parry, Head of Sustainable Investment at Newton Investment Management. This conversation is a unique one. It looks at ESG from a very much a critical way as to the issues and challenges alongside implementation of ESG, the definitions of ESG alongside social norms, alongside the new regulation changes that are coming alongside stakeholder management and the ruling by the Department of Labor around the primacy around fiduciary duty. I hope you enjoy this conversation. How do you see ESG in this world of COVID? How has it changed or evolved in the last few months?
Well, it's been quite a dramatic transformation in many ways. Over the course of 2020, and it's coming in a multiple different ways. It's one of the most obvious is the huge inflows that we're seeing around the world. We've had record inflows into ESG labeled or sustainable labeled investment portfolios in fixed income as well as equity. So that in itself is amazing, given the outflows from many traditional funds, particularly in the earlier part of the year. Now, behind that is a great emphasis on climate. So we are beginning to see particularly asset owners emphasize their climate objectives in either active or passive strategies, many of them with an ESG or sustainable type label tilted. So that's something that really has accelerated. I think the asset owner community, backed by the sort of private wealth area, have really sort of finally fully embraced a view on climate change and are beginning to put that into action. Also, you have to think about what ESG is. And, I sometimes have to remind myself to spell it out a bit more. It sounds really trite to say it's environmental, social, and governance, but I think when we're talking about this, particularly to a non-professional audience, it's really important to actually spell out what ESG is, because it's not some abstract acronym. It actually stands for some really incredibly important issues. And what I was going to say was that it's the social dimension that has really begun to be of interest to particularly asset owners over the course of this year. First and foremost, COVID has been a human crisis, both for the health and the loss of life that it's visited upon us, but also the social consequences of the economic fallout that's going to endure and linger for many years with unemployment. So, and I think that's really sharpened the focus on S, which within the ESG space had always been an area that we probably more struggled on, because it's a harder area to define, it's a harder area to get data on. So if COVID has done one thing, it's about advancing the cause of S, social, in the debate and discussions on how to integrate ESG into an investment approach.
It's interesting you say that, because if I look through most of the portfolios of ESG labeled portfolios, they're very much filled with tech stocks. And these tech stocks have been the ones that have actually benefited the most through COVID, as traditional retail, as traditional real estate, infrastructure have all been hit quite hard. It's the tech stocks that have done quite well. So is ESG getting a bit of a wind beneath its sails in terms of gaining from the transformation of the economy due to COVID?
Yes, and I think that transformation was one that was going on already. COVID, for some people, is about to tilt the world on its axis and was going to usher in a new normal. However, in practical reality, in the short term, it's accelerated trends that were there already. We've seen, the concentration of market capitalization in the tech stock grow. Their businesses have generally thrived over this period. So it's given that consolidation of market share, given the market share gains as we've all learned to work from home. Now, that great from a pure financial return performance perspective, but I think it does begin to raise some specters over the longer term. It does raise worries about over-concentration of in market share. It gives you some worrying concerns about potential monopoly. These platform companies have an ability to see all the flow in the system. So therefore, does that give them an unfair advantage? Are they gaining undue dominance by being able to control that flow because they see it before anybody else? And I do worry a little bit that as we come out of the COVID crisis, it's going to be what I would call the beating heart of entrepreneurialism, the small enterprises, the mom and pop companies, the medium-sized companies, the old SME sector, that are going to find it very difficult to gain traction. I think in the US, there was a stat that saying nearly 40% of restaurants have already shuttered. So we do then have to think about the role of dominant players in any industry, actually in its position in long-term social outcomes. And I think this could be one of the big challenges for ESG over the next decade, is actually in the way that maybe a decade ago when the oil or fossil fuels dominated the index and we talked about externalities not being internalized, do we now have growing externalities in some of these really very dominant industries, both public and private? Some of these is reflected in the private equity market as well. And I think that is going to be a question around the social aspect of ESG over the next decade. What happens with tech? What happens with monopoly and dominance? Are we going to actually begin to see governments swing back the other way and enforce antitrust, for example?
Well, there's a potential real risk then, for these ESG funds that are significantly tech heavy, as they keep growing and they've got this momentum behind them and more money pours into ESG funds, which then pours into these tech companies. Yes, they become quite large. Then you raise the red flags of regulators. There could be then a potentially hidden risk or inherent risk in these sort of portfolios if you're just investing in ESG blindly.
Well, these are going to be inherent risks in all portfolios, but I do think you make an important point there about ESG and momentum. At the moment, as we see a sort of almost a tsunami of money into the sector, and a significant proportion of it into passive, there is this danger of a compounding effect of momentum in the sort of ESG darling sustainable winners that can take their valuations way beyond their economic worth. And I do always worry when something becomes fashionable. I've been in the industry 35 years, and it's probably the first time I've been fashionable, that's for sure, that once something becomes fairly ubiquitous and everybody's talking about it, do you then end up stripping it of its utility? If we'd been having this conversation maybe 12 years ago, before ESG was really talked about widely, we might have been talking about value versus growth and why you never needed to own a growth stock. And that was the dominant thinking of the time. Yet every year, virtually for 12 years, growth has outperformed value. So, I think the way we have to frame ESG is it's not a label, it's not an outcome in itself. Sustainability is, that's what we're trying to achieve, a sustainable, robust system that balances economic growth with social consequences and operating with environmental boundaries. But with ESG, I think very much it's an input into the decision making. It's about business models, the risks, the opportunities. And these are inputs that are part of the rich mosaic of having the full picture. ESG characteristics don't change on a second by second basis, but prices do. And of course, we have to reflect that valuation, business models, cash flow, competitor analysis, where in the value chain is value accruing, all these factors still have to be assimilated into share prices. And I do worry that at times as people rush to get a shiny ESG label, if they're looking at just the label and the score and not enough about the other variables that influence business, that we could end up with outcomes that disappoint people. So put it another way, it's not that ESG outperforms, it's that not integrating ESG probably hinders your ability to to outperform. So, I think we need to be careful about the nuances of how this is, how it's presented. It comes back to my point. It's not an abstract acronym. It does not exist on its own as an independent entity. It's an input, not an output.
As so much flow chases ESG, again, labelled companies, is there also, would you feel, potentially a capacity constraint for the types of companies that people really want to get to? If you're thinking about ESG as an asset allocator and you say, well, I want the best companies, is there enough capacity out there for them to allocate to the best companies out there, or do they need to sort of drop down the levels of ESG and then be more of an advocate and try and push for better performance and better behaviour of these companies?
Well, look, ESG is our influences on all companies, large and small, across all sectors, and they have it has different levels of materiality across environmental, social, and governance in different regions, different industries, etc. So it's there as an influence for all businesses. So I don't think in that sense it is capacity constrained. Now, if you're actually going to be very prescriptive about it and narrow it down, say, to just solution providers, then yes, you do end up limiting your choice, and you're already into an area where many of the sort of what would be deemed as solution providers are trading on very rich valuations. So, that aspect of it does worry me. When I talk to companies, it's really interesting because companies are absolutely intrigued by ESG, and they want to know how they remain relevant. How do they get people continuing to invest in their shares? And it's really interesting to see how different companies respond. I had one major fossil fuel company ask me, how do we optimize our ESG score? And, you're trying to say to them, that's not what it's about. It's about your behaviors and your purpose and how you're managing the risks and the transition in your business. If you think it's just about a score as a corporation, then you're just putting greenwashing on the front of your business without actually changing your allocation patterns. So in that conversation, and there's always our conversations with companies, it's about what the companies are doing. This is probably the most important way to think about it. It is, to paraphrase the old Bill Clinton elections slogan, it's the companies, stupid. These are the people allocating all the different forms of capital, human, social, natural, financial, intellectual relationships, etc., to build resilient and relevant businesses that will endure over time. They're having to hire, and as well sadly fire people at the moment. They're dealing with complex regulations. They might have 60, 70,000 companies as primary suppliers in their supply chain. They are big, complex businesses. So that's where it's really important, is actually try to get into the mindset of how companies are integrating sustainable practices into their operations. How do they understand the notion of what their purpose is? Because that's the only way that you can make it real. And that takes it away from a score or a label to actually understand what they're really doing with capital and what it means for their business. And going back to your first question about ESG and how it's changed, I think what's really suddenly changed is companies are recognizing that the world is in an accelerating period of transitions, whether it be in technology, in health, in society, in geopolitics, in global trade, etc. And that's challenging the relevancy of their business. And for me, that's why when you have more private conversations with companies, that's why I believe they're beginning to look at stakeholder approaches, because they're beginning to realize that just a focus on the primacy of the shareholder could mean that they become stranded, that their businesses don't become relevant. And I think that stakeholder mentality is probably the bit that I'm the most optimistic on, as long as then shareholders are called into account on their claims of being stakeholder orientated.
I'm curious on your thoughts around that stakeholder management piece. You gave the example of the oil company there. and trying to sort of think about how can they improve their rating. And I guess in their mindset, they feel that if you have a higher rating, that you'll end up falling into maybe new passive ESG funds that will then drive more money into their stocks and help their valuation. But is there now a potential situation that if companies feel that they can't do enough to get their ESG scores, that maybe it's better for them to be private and that there's maybe less scrutiny for them if they're private rather than on the listed markets?
And undoubtedly, we've seen that in some challenged areas, increasingly in areas like coal, where, there's a real investor opprobrium heaped on anything to do with coal. And we have seen that shift. And I think sometimes you see that lead to very poor local, environmental, and even social outcomes. Look at some of the actions in private companies in West Virginia. It looks like an environmental disaster there. And I think that's one of the other challenges with this is that many companies are actually disposing of activities which are seen as being negative, whether it be oil and gas or coal or other activities like that. But if they're not being wound down, but they're going to a private ownership, then they go into a shadowy world with less accountability, less governance. And, that's maybe good for the listed corporate entity in that it's removed, if you like, an ESG discount from being associated with an activity that has maybe negative environmental consequences through climate change. But if that business that they have disposed of continues to exist and with less scrutiny, then you actually haven't changed anything. You just, there's a danger that it becomes, about virtue rather than the practical necessity to create a more sustainable system. So yes, I think there are sometimes these consequences of in our desire to look good and to change the system that maybe we don't always get the actions that we want if they go from public to private and fall out of view.
It's interesting you mentioned about virtue there, and one of the things that comes to mind, particularly in the Australian marketplace, is the number of funds talking about lower and lower carbon footprint in their portfolio. When I hear that, it seems like the easy choice, particularly as the number of companies in the indices and the value of these companies in the indices is getting lower and lower, and the actual relevance to your total portfolio is getting smaller. So that's an easy way to win. Curious on your thoughts around how ESG gets sort of taken advantage of and people almost playing with the label to try and show that they're doing the right thing. But then as we go into the more deeper issues around social, that they're sort of discounted.
The problem with the label and methodologies, particularly when they come, is that they can be gamed. It's very easy once you know a methodology for creating, what looks good. Then you can just overemphasize the things that score well and underemphasize those things that score poorly. A lot of people in the early days of ESG, as a result of that, were very surprised when they opened up their ESG fund as individual investors to find tobacco, because tobacco stocks score well on ESG, and that was sort of contrary to their values or to what their expectations. And that's why I think it's really important to continue to link ESG to business performance, to business activities, the allocation of capital. If you think about it around TCFD reporting, which is, we're real big supporters of, and I think is going to help shine the light on things. But if the oil and gas companies are actually reporting under TCFD through their statutory requirements, but in their management accounts aren't taking account of the climate risks and challenges, then it's not going to be really very much help. So it's about what companies are doing, not what they're reporting, and certainly not necessarily what the ESG rating agency is reporting. We know that we've had plenty of examples of high ESG scoring companies recently, Indian coal companies getting incredibly high ESG scores, which seems to be counterintuitive to the average investor in a fund. So I think that has to be always at the back of our mind. First and foremost, if you're an active investment manager, then we still have to produce performance over and above that of the index. And therefore, for us, these are ESG risk management issues. It's about we have to assimilate all of that into it. We can't take a position just on virtue. We have to understand what it means for business models, what areas can be avoided. And it does come down to it with many of the fossil fuel companies. It's just all, why bother? And now that sounds, really trivializing the problem, but, it's a very different scenario if you're an asset owner, a universal owner, an index manager, to if you're a performance-driven active manager picking 30 to 50 stocks. We're always omitting. It's not divesting. It's just we make a limited number of choices where we're taking into account a whole array of factors. So there is sometimes a mixture of language that can be unhelpful. It's very different if you're a universal owner owning the market, owning beta, where engagement is your lever for delivering better outcomes. That can be very different to an active manager where you're using engagement to understand and get a better feedback loop and change behaviors for the specific benefit of your strategy. Now, that they don't have to be misaligned. They can be highly aligned around climate change, but we have to recognize there are different ways that this will get played out in the market. And we still do need price discovery in the market, which is another reason why we can't rely on methodology alone. We have to have that divergence of opinion and thought and action.
I can see the total benefits of the divergence of opinion to create a market and have market participants going back and forth. But at the same time, when I listen to what you're saying, I think to myself, well, hold on, do we need some sort of an ESG disclosure standard for investment products so that people can actually compare what's actually happening across all different asset managers?
I think we need better disclosure. I think we need greater transparency. I think all asset managers at the moment are striving to illustrate what good looks like to their clients. I think the key thing is transparency rather than a standard. If you think about growth, the S&P define growth differently to MSCI, yet they've been around for 85 years as concepts. So it's not so much about having a standardized disclosure. I think where we need standardized disclosure is at the corporate level. This is something that the EU has raised, and ESMA, because obviously in Europe, the focus on ESG is intense with the EU sustainable taxonomy. There, I think that's about democratizing ESG data. At the moment, access to ESG data is expensive. The definitions that are inconsistent across the big data providers. It doesn't necessarily have to be a bad thing, because if it all looks the same, there's no value. But the problem is that there's no standardization at the corporate level. And so 3 years ago, if you talk to companies, they really didn't want mandatory reporting around sustainable issues or ESG considerations. Now that they're producing scores sometimes of surveys every month for different data providers, some for big asset managers, etc., they're beginning to realize that actually a standardization of reporting into the statutory reports might actually be a good thing. They then take control of their data in the sense that it's their data, it's audited, it's reported, it's standardized. And this is what happens in the accounting industry. Things evolve and change and adapt. And I think that needs to happen before we get really good and consistent standards of reporting at the asset management level. So I think sometimes it gets pushed around the wrong way, and people say, well, we have to standardize the way that asset managers report. Well, if the data that they're using isn't standardized, isn't fully audited, and goes through the filter of a normalizing ESG data provider, how do we actually achieve that? You would be then going back to our problem of, maybe of market control. You have people in the middle controlling what good looks like. So I think really the one thing I continue to push for is companies having a standardized set of reporting. When I started over 30 years ago in the industry, we didn't have a cash flow statement. And an amazing amount of pushback from having a cash flow statement. We now have a cash flow statement as a standard part of international accounting. Yeah, accounting standards change to reflect the demand from the end users, and I think that's where I'd like to see the change first, is at mandatory reporting.
That was the direct example that I thought about, which is around the accounting standards and the cash flow statement, and it's pretty consistent around the world. And when there's any deviations that are there, you have to put it as a note. So likewise with ESG, there could be this similar sort of approach. I guess one of the reasons why people may push back against ESG is that sometimes it's a bit softer. It can't be quantified in the same sort of way that the accounting standards can be done. But at least there's a baseline that can ask for specific details to be provided.
Yeah, well, let's have the debate, because if you say, Alex, if it's softer at the corporate end, by the time it gets distilled down, manipulated and squirted out at a portfolio end, it's going to become even softer. We can't make it harder at the output level if the input is soft. So that's what I'm reflecting, is that if we have better data in, then we have a better quality of data out.
One of the things I wanted to go back to specifically is around that social aspect, because it seems as though the social part is still not really being thought about in a deep enough level. And one example that I've seen recently is these car ride companies that have a huge amount of contract workers, claiming to be very friendly organizations, but at the same time, their social relationships with their employees is not good. Likewise, a number of the key tech companies hold huge amounts of employees under short-term contracts. And I wonder whether that can tick the box of being socially responsible as an organization in this new world.
Yeah, I think one of the ways to think about this is that all companies are de facto social enterprises, whether they like it or not. Our parent company, BMW Mellon, they employ, I think, 65,000 people. That's the same size as my hometown in South Wales. And unlike a community, like a town, that we provide economic benefits, jobs, we provide other benefits like pensions, healthcare, help with preschool, childcare and issues like that, ongoing education and training, etc. And I think actually the more prescient companies are beginning to recognize that role that they have. And that's why I went back to the comment about stakeholder capitalism. I thought it was very interesting in August last year, so well before the COVID crisis, that the Business Roundtable updated their statement of corporate purpose to talk about stakeholders, how they treat workers with fairness and dignity, providing benefits and training and ongoing education. Then about how they treated their customers, with honesty and transparency, selling goods and services as labeled, around supply chains and the responsibility in supply chains, and to communities as well as to shareholders. Now, that actually, when you read back through it post-COVID, is actually got a good framework for holding companies to account for their behaviors against that sort of framework. And I think it comes back to the concept that shared prosperity, so good socialization of prosperity, is actually ultimately going to be very good for businesses. If we have narrow pockets of wealth that's not shared more broadly across society, then ultimately, when you go to the furthest extremes of that, having a limited number of billionaires is not actually going to be ultimately very good for your social, for your business, particularly if you're keeping spending going in the rest of the economy by slashing interest rates and making it heavily reliant on debt. So over the long term, operating within environmental boundaries and having a well-functioning, prosperous society is actually good for business. And I used a word before, relevance, and I think maybe this is why even in the US, that some of the largest businesses are beginning to think about stakeholders, because it's about how do they remain relevant in a rapidly changing world with, not just the technology and global trade, but social norms changing an awful lot. And I look at my children's generation and their attitude to work, their attitude to consumption and behaviors are very different to my generation. And I think that's part of the reason why we really need to get stakeholders. Now, that is a great way of then rethinking that social contract. So Rousseau wrote about the social contract, many hundreds of years ago, and it still remains important if you want to have a business that in the future is going to be resilient and relevant. Is regulation could change, social norms can change very rapidly. We're seeing that with the acceleration of alternative fuels, renewables versus fossil fuels. It wasn't that long ago where it seemed unthinkable that Britain would be producing no electricity from coal, as we are today, but producing approximately 40% of our electricity from renewables. And I'm going to say we had the most progressive approach to green energy in Britain at times. So, we are seeing these rapid changes, and I think the social dimension is one that could change very quickly.
What do you think about the regulation that needs to potentially evolve for this to become more open, right? You talk about stakeholder management, and I think many people would agree that without good stakeholder management, your business is going to have trouble. But at the same time, there's this fiduciary duty that the company needs to put in place, and the asset owner and the asset manager all needs to put in place. And how do they try to map, taking into consideration all the stakeholders, and at the same time making sure they meet fiduciary duty? And ask that question with the Department of Labor's decision with fiduciary duty as the primary concern.
Yeah, and at the end of the day, helping your members, if you're a pension scheme, retire well, i.e. financially healthy, is your prime objective. But you still want that to be in a healthy and vibrant world. There's not a lot of point in retiring into a dystopian, wilderness behind your barbed wire electrified fences. But I think, for me, the way I look at being a sustainable investor is that it is still about achieving good fiduciary outcomes. It's about having a lens for looking over the long term at the direction of travel of the economy and of businesses, which is why I always come back to it's about the business model that is really so important, is that's the enactment of where civil society votes for where it wants to be. Now, I would say that over the short term, there can be a dynamic tension between financial returns, social consequences, and environmental outcomes. But the best managed enterprises manage that dynamic tension well and operate within those three vectors. You can stray outside of financial prudence for a while, but that normally comes home to bite you, as quite a few over-leveraged business models have discovered in the last 6 months. You can push your environmental boundaries for only so long before there's either a cost through fines or whether legislation changes. And similarly with social, you can only get away with pushing your workers so far before there is a backlash. And even some of the gig economy companies that use zero-hour contracts do find that within operating bands. Now, I think the big challenge is that with any businesses that build a moat that is so unassailable that it creates a monopoly, and we have venerated moats, and we need to think about that, is there is a mechanism of law, whether it be around antitrust. Monopoly as a concept that is normally frowned upon in most economies, because ultimately it's a poor allocation of capital. It was an issue in the 1920s. In America, they had to break up Standard Oil, which I believe controlled about 90% of the flow of oil. So there are mechanisms, and there are for tackling this. And I think that is going to be a decision at some point that we have on any industry or business where they are potentially exerting undue influence and control. At the moment, the political landscape has been largely to ignore that. And even in Europe, we've seen talk of building national champions. It took me almost back to the 1970s when I heard that. But these things do normally swing back. And I'm beginning to see, in the US, I think we're talking about what your politics is, that people on the left and right are beginning to worry about the lack of enforcement of antitrust. And if we begin to see that as we come out of the COVID recovery, that the dominance in certain industries creates or stifles job creation, I think that could begin to challenge some of these issues. So as investors, as asset owners, this is going to be a topic that we need to keep a very close eye on. Will regulation swing from focusing on environmental to maybe more social norms? And if we have sticky unemployment, if we have slower recovery than anticipated, despite the $17 trillion of stimulus, then questions I'm sure are going to be asked, about the role of dominant industries. History tells us that this happens. So maybe it's not an issue for now because the momentum and the performance and the profits push you the other way. But it is something to be aware of and to keep an eye on over the unfolding of this decade.
A final question, and we spent a lot of time on E and S, but G and governance has always seen some very strong results from an empirical test of looking at poor governance has usually very negative returns financially. In this market with a lot of liquidity, governance seems to take a back seat because performance is doing quite well. I'm just curious on your thoughts around what's been happening in the governance space for a lot of these businesses.
No, you're quite right that governance is, if you had to rely on one area to look at it, it would always be governance. Irrespective of whether you use ESG, believe in ESG or not. I think everybody believes in good management, or certainly believes that bad management can destroy shareholder value pretty quickly, and it tends to be the worst companies in terms of governance where the issue lies. It's not so much further up the spectrum. The difference between the very best and the middling is not so big. Interestingly, I think some studies have shown that governance in US tech is inversely correlated with performance. So, because they're entrepreneurial, fast-growing companies and people suspend their disbelief. Now, I think the thing with governance is that it's always there as a factor. It just depends on when it becomes an issue. Think of it another way as well, that good governance is the route to better performance on environmental and social factors. You need to have a good governance to be able to think about that more stakeholder approach to managing your business. So it does have wider implications, not just around the governance of the entity, but also the enactment of other areas. It also works with countries as well as companies. I think the issue with governance now is that I think it's one area where shareholders they're almost all becoming activists. So the level of engagement with company management, the greater level of voting by passive, that has been a huge swing. The passive industry historically were labeled as absentee landlords. They've moved on a long way from that now, which is great that they have a vote as well, and they should exercise it for changing. So I think really where the governance has been really transformed is in this notion that they're all activists now, and that shareholders are far, far more engaged in discussions around these issues. Certainly know that from our client base across institutions or financial intermediaries, they are much more engaged in it, and they now want us to increasingly express their voice, their concerns to the companies that we own on their behalf. And so that's why I do think ultimately some of these social norms will change, because our clients are a reflection of broader society, and they're beginning to reflect many of these issues. Where it comes back to then is, do governments and regulators enact it? So, for example, modern slavery is an issue that we hear a lot about, and it's been raised right around the world because it remains a worrying problem even in the developed, so-called sophisticated world. But nobody, as far as I'm aware, has been fined, no corporate under the Modern Slavery Act, for example, in Britain. We have unlimited fines. So I think we will probably begin to see that we shouldn't just rely on shareholders as being enforcement of these rules. We do need broader civil society to play their role as well. And that's where I think we are beginning to see the changes that governance is amplifying moves more broadly in society.
Mm-hmm. All right, Andrew, that's been a fantastic conversation. Thank you very much for your time today.
Yeah, it's been a real pleasure. Thank you, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.